autumn of 2008, as financial institutions worldwide teetered on the brink of collapse.
It was the worst day on Wall Street since the crash of 1987.
By between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate.
An enigmatic figure operating under the pseudonym Satoshi Nakamoto quietly published a 9-page white paper online. This seemingly modest document, titled Bitcoin, a peer-to-peer electronic cash system, would plant the seeds of what many now consider the most significant financial innovation of the 21st century. Today, in 2025, we find ourselves at a curious inflection point. Bitcoin has transcended its origins as a niche experiment to become integrated into our global financial architecture. This is no longer a story of prophetic enthusiasts versus dismissive skeptics. This is a story of systemic evolution. But to understand Bitcoin's significance, we must first understand a fundamental question it attempts to answer. Who controls money? Throughout human history, we've relied on trusted intermediaries to facilitate economic exchange. Banks verify your balance. Clearinghouses process your transactions. Central authorities issue currency. These intermediaries essentially define what money is and how it operates. Bitcoin proposes a radical alternative. Instead of centralized trust, it offers mathematical verification. Instead of institutional authority, it offers distributed consensus. For the first time, value can be transferred without requiring trusted third parties, a proposition that would have seemed impossible before 2008. Consider what transpired on May 22, 2010. A Florida programmer named Laszlo Hanyecz was hungry. Rather than reaching for his credit card, he posted on a Bitcoin forum, offering 10,000 Bitcoin for 2 large pizzas. Someone accepted. That seemingly ordinary transaction, now commemorated as Bitcoin Pizza Day, marked Bitcoin's transition from theoretical construct to practical medium of exchange. Those pizzas, incidentally, would be worth over $500 million today, making them perhaps the most financially consequential fast food purchase in human history. One has to wonder if Laszlo enjoyed those pizzas. One hopes they were at least properly cooked. What followed was a series of spectacular boom and bust cycles that would give cardiac palpitations to even the most stoic financial analyst. Critics pointed to this extreme volatility as evidence of Bitcoin's fundamental worthlessness. Nothing of actual value, they reasoned, could fluctuate so wildly. But this surface-level analysis missed something crucial. Each market cycle filtered participants in a peculiar way. Speculative manias attracted attention. Subsequent crashes eliminated the purely opportunistic, while those committed to the underlying innovation remained to build infrastructure regardless of price fluctuations. To appreciate why this matters, we need to understand Bitcoin's technical foundations. Imagine a ledger, a record of all transactions ever conducted. But unlike traditional ledgers maintained by a single entity, this one exists simultaneously on thousands of computers worldwide. Every transaction is verified independently by multiple parties. Every new group of transactions, called a block, is cryptographically linked to all previous blocks, forming an unalterable chain back to the beginning. This architecture achieves something previously thought impossible: digital scarcity without centralized control. There will only ever be 21 million Bitcoins. No entity can unilaterally create more. No authority can freeze your holdings without possessing your private keys. The system is secured through what's called mining, a deliberately resource-intensive process that makes attacking the network prohibitively expensive. Miners compete to validate transactions because they're rewarded with newly created Bitcoin. This elegant arrangement aligns profit motives with network security. Participants are incentivized to follow the rules because breaking them would undermine the very system that benefits them. In 2025, we're witnessing Bitcoin's integration into mainstream finance.
And if Bitcoin is going to the moon, as we say, it's going to the moon.
President Trump's executive orders establishing a specialized crypto task force and Bitcoin reserve. The European Union's regulatory framework. Major U.S. financial institutions offering comprehensive crypto services. Bitcoin ETFs attracting significant capital inflows. Perhaps most telling is Bitcoin's decreasing volatility. Monthly fluctuations have stabilized around 1.2 to 1.4%, occasionally lower than traditional equity indices. The wild stallion of finance is gradually being domesticated, not through constraint, but through maturity. But significant challenges remain. Unlike traditional financial assets, Bitcoin security rests entirely with the holder. Your Bitcoin is only as secure as the private keys controlling it. Lose those keys, and your Bitcoin vanishes permanently into the digital ether. No customer service line, no recovery process, just mathematical finality. The regulatory landscape remains fragmented globally, creating uncertainty and compliance complexities. And despite recent stabilization, Bitcoin's history of extreme volatility demands extraordinary emotional discipline from investors. Perhaps the most profound question is what Bitcoin represents in our economic system. Is it a speculative technology investment? A hedge against monetary inflation? Digital gold? The answer likely depends both on your perspective and on Bitcoin's continued evolution. What's certain is that Bitcoin has initiated a global conversation about the nature of money itself, a conversation that transcends investment prospects to question fundamental assumptions about value, trust, and economic organization. Whether Bitcoin ultimately succeeds or fails as a monetary system, it has already achieved something remarkable, forcing us to reconsider assumptions about money that have remained unexamined for generations. Whatever your relationship with Bitcoin, as investor, user, observer, or skeptic, you're participating in a living experiment unlike anything in financial history. An experiment that began with 9 pages of text, published by someone we still cannot identify with certainty during one of the most significant financial crises of the modern era. If nothing else, that makes Bitcoin one of the most fascinating stories of our time.